If you thought the AI investment bubble was the risk, you're looking at the surface. Because the real danger isn't the bubble itself. It's what the bubble is connected to. AI valuations have surged. Capital has concentrated. Expectations have expanded. But behind those valuations sits something larger. Debt. Liquidity. Passive flows. Pension exposure. Corporate leverage. When a sector becomes large enough, it stops being a theme. It becomes infrastructure. And when infrastructure reprices, the impact spreads. The dot-com crash didn't just hurt tech investors. It hit pensions, corporate balance sheets, confidence, hiring. The AI investment cycle today is not a niche speculation. It is embedded in major indices, retirement accounts, exchange-traded funds, corporate strategy, national policy. That means the risk is not isolated. It is integrated. And integration changes everything. If AI stocks correct sharply, the repricing will not stay confined to venture capital or tech traders. It will ripple through capital markets. Because AI is no longer just a story. It is a weight-bearing pillar in today's financial structure. And pillars matter. Especially when they're carrying leverage. To understand why this bubble could be larger than it appears, we need to examine where exposure truly sits. AI is now systemically embedded. The first phase of any innovation cycle is enthusiasm. The second phase is adoption. The third phase is integration. AI has entered the integration phase. Large corporations are restructuring around it. Cloud providers are reallocating capital expenditure. Semiconductor producers are scaling production capacity. Software firms are repositioning product roadmaps. But beyond corporate strategy, AI is now embedded in financial architecture. Major stock indices are heavily weighted toward technology firms. When AI-driven companies outperform, index returns concentrate. Passive funds allocate capital automatically based on market capitalization. As AI leaders grow larger, passive exposure grows larger. This creates structural interdependence. Millions of retirement accounts hold index funds. Those index funds hold concentrated AI exposure. If AI valuations rise, household net worth rises. If AI valuations fall sharply, household wealth contracts. This wealth effect influences spending behavior. Spending influences economic growth. Growth influences corporate earnings. Corporate earnings influence valuations again. The loop tightens. Another layer of integration lies in corporate leverage. Companies often borrow against strong equity valuations. High stock prices improve credit perception. Improved credit perception lowers borrowing costs. Lower borrowing costs fund expansion. If equity prices decline, credit spreads can widen. Wider spreads increase borrowing costs. Expansion slows. Now consider pension funds. Pensions allocate capital to public equities. Large-cap technology exposure has grown over time. If valuations compress rapidly, funding ratios may deteriorate. Governments may face pressure to increase contributions. Public finances tighten. The bubble shifts from market issue to fiscal concern. Then there is venture capital. Private AI startups are funded based on public market comparables. If public valuations compress, private funding tightens. Hiring slows. Innovation investment contracts. The ecosystem becomes cyclical. AI is no longer speculative fringe. It is intertwined with public markets, corporate balance sheets, household wealth, pension systems, national industrial policy. When a theme becomes this interconnected, volatility in that theme becomes macro-relevant. This is why scale matters. A small bubble pops quietly. A large bubble reshapes capital allocation. And AI is no longer small. The systemic question is not whether AI companies are profitable. It is whether the financial system can absorb repricing without broader instability. Because when integration deepens, fragility increases. In the next section, we examine leverage and feedback loops, and why feedback loops make large bubbles more dangerous than small ones. Leverage and the feedback loop problem. Bubbles become dangerous when leverage enters the system. Leverage does not just amplify returns. It accelerates reactions. When prices rise, leveraged positions expand faster. When prices fall, forced selling begins sooner. AI exposure today is not purely equity ownership. It exists inside layered structures. Margin accounts, hedge fund positions, options strategies, structured products, corporate debt backed by equity valuations. Each layer adds sensitivity. If AI equities decline gradually, markets adjust. If they decline sharply, leverage triggers acceleration. This is how feedback loops form. First layer, equity repricing. If earnings guidance disappoints or growth slows, prices soften. Second layer, margin pressure. Investors who borrowed to increase exposure must either post collateral or sell. Selling increases downward momentum. Third layer, derivative hedging. Options market makers adjust positions as volatility rises. Hedging activity increases price swings. Fourth layer, passive fund adjustments. As market capitalization shrinks, index weighting shifts. Funds rebalance. More selling pressure appears. Each step feeds the next. The risk is not simply price decline. It is synchronized reaction. When a sector becomes dominant in index returns, its correction influences broad sentiment. Sentiment affects liquidity. Liquidity affects stability. There is also corporate leverage. High equity valuations allow companies to issue stock for acquisitions, to raise capital cheaply, to fund expansion. If equity prices compress, financing conditions tighten. Capital expenditure plans pause. Hiring slows. This shifts the labor narrative. AI has been associated with automation-driven job displacement. But a funding slowdown can produce a different effect. Hiring freezes inside the AI sector itself. This dual dynamic compounds uncertainty. Now consider confidence channels. Financial markets influence expectations. If AI stocks decline significantly, retail investors may reassess risk tolerance. Reduced risk appetite affects other sectors. Capital rotates defensively. Credit spreads widen. Risk premiums increase. The broader economy feels tighter conditions even if policy remains unchanged. This is the nature of feedback loops. They transform isolated corrections into systemic adjustments. Large bubbles are not defined by price alone. They are defined by interconnected exposure. The more layers connected to a theme, the greater the sensitivity. AI is embedded in cloud infrastructure, semiconductor supply chains, venture capital portfolios, public market indices, retirement accounts, corporate borrowing. When a theme touches all of these, repricing becomes more complex. It moves beyond traders. It influences allocation decisions across institutions. An institutional reaction can amplify volatility. The question is not whether AI valuations will correct. All sectors experience cycles. The question is whether the system can absorb that correction smoothly. If leverage is moderate and liquidity stable, adjustments are manageable. If leverage is elevated and liquidity tight, the adjustment accelerates. This is why scale matters. AI is no longer speculative edge. It is central. And central themes do not unwind quietly. In the next chapter, we examine macro pressure. Because bubbles do not unwind in isolation. They unwind within broader economic conditions. Macro pressure and the policy constraint. Bubbles do not exist in a vacuum. They exist inside macroeconomic conditions. And today's macro environment is very different from the one that launched the AI surge. When AI valuations accelerated, liquidity was abundant. Interest rates were low. Capital was inexpensive. Discount rates were compressed. Future earnings were valued generously. But the macro environment has shifted. Interest rates are higher. Central banks are cautious. Inflation sensitivity remains. Debt levels are elevated. This changes the tolerance for volatility. In a low-rate world, central banks could respond aggressively to market stress. Lower rates. Inject liquidity. Stabilize sentiment. But in a higher-rate environment, policy flexibility narrows. If inflation remains a concern, aggressive easing becomes harder. That means financial markets must absorb more of their own volatility. Now consider debt levels. Public debt is high. Corporate debt is elevated. If equity markets decline sharply, borrowing costs may rise. Higher borrowing costs increase fiscal strain. Fiscal strain limits policy maneuverability. The AI sector intersects with this reality. Governments are investing heavily in AI infrastructure. Industrial policy initiatives are expanding. Subsidies, research funding, strategic national investments. If AI valuations compress while public spending rises, fiscal risk increases. If fiscal risk increases, bond markets react. If bond yields rise, equity discount rates rise. Higher discount rates pressure valuations further. This is the policy constraint loop. Another macro layer is productivity expectation. AI is often positioned as a productivity solution. If productivity gains materialize, growth strengthens. Stronger growth offsets valuation risk. But productivity improvements are rarely immediate. There is integration time, training cycles, organizational restructuring. During that transition period, growth may not accelerate fast enough to justify elevated valuations. If macro growth slows while AI expectations remain high, the gap widens. That gap is where repricing begins. There is also geopolitical tension. Nations are competing for AI leadership. Supply chains for semiconductors remain sensitive. Export controls influence capital allocation. If geopolitical tension escalates, uncertainty increases. Uncertainty affects investment appetite. Investment appetite influences valuations. Large themes are rarely insulated from geopolitical dynamics. Now combine higher rates, elevated debt, policy constraint, geopolitical uncertainty, concentrated market exposure. This is not a fragile environment by default. But it is not forgiving either. When bubbles unwind in supportive macro conditions, corrections can be absorbed. When bubbles unwind under policy constraint, adjustments become sharper. The AI bubble, if it exists, is larger not only because of valuation, but because of context. It is growing in a tighter macro system. And tight systems respond more abruptly to stress. In the final chapter, we examine the most important question. Not whether the bubble pops, but what happens if it simply slows. Because slowing momentum in a concentrated theme can reshape markets even without collapse. What if it doesn't pop, but just slows? When people think about bubbles, they imagine crashes, sharp declines, panic selling, sudden collapses. But not all bubbles end that way. Some simply lose momentum. And when a dominant sector loses momentum, the consequences can be just as meaningful. If AI valuations stop expanding, capital flows shift. Momentum investors rotate out. Growth premiums compress gradually. Returns flatten. This may not look dramatic, But in a market heavily dependent on AI performance, stagnation can have ripple effects. First, passive exposure. If AI leaders stop driving index gains, overall market performance slows. Slower index performance influences retirement portfolios. Wealth growth moderates. Consumer confidence weakens subtly. Second, capital allocation. If AI stocks stop outperforming, venture capital enthusiasm cools. Funding rounds become smaller. Valuations reset downward. Startup hiring slows. Innovation continues, but at a measured pace. Third, corporate behavior. If share prices stabilize or decline modestly, executive risk tolerance shifts. Capital expenditures become more selective. Buybacks slow. Expansion plans tighten. Even without a crash, momentum loss alters decision-making. The structural issue is dependency. When a single theme drives disproportionate optimism, growth expectations align around it. If that theme underperforms, the growth narrative must be rewritten. Markets do not need collapse to experience volatility. They only need expectation adjustment. Now consider macro implications. If AI fails to deliver rapid productivity gains, growth forecasts may be revised downward. Downward revisions affect bond yields. Lower growth expectations can tighten fiscal projections. Debt-to-GDP ratios worsen without acceleration. Policy flexibility narrows. This connects directly to previous episodes. Debt sustainability depends on growth. If AI was assumed to boost productivity meaningfully, and that boost is delayed, fiscal arithmetic shifts. Another subtle risk is narrative fatigue. Innovation themes thrive on momentum. If headlines transition from breakthrough to integration challenge, sentiment cools. Sentiment cooling reduces speculative appetite. Reduced speculative appetite lowers volatility initially. But it also reduces liquidity. Lower liquidity makes markets more sensitive to shocks. The bubble may not need to burst violently. It only needs to fade. And when dominant narratives fade, markets search for new anchors. If no alternative growth engine emerges quickly, uncertainty increases. Uncertainty affects spending. Spending affects earnings. Earnings affect valuations. The loop remains intact. The AI bubble, if it exists, is larger than price charts suggest because it intersects with household wealth, pension allocation, corporate leverage, fiscal policy, monetary constraint, geopolitical competition. It is not isolated. And when a theme is this embedded, even gradual deceleration reshapes expectations. The key question is not whether AI transforms the economy. It likely will. The key question is whether financial markets have already priced in too much, too quickly. If they have, the adjustment may not be explosive. But it will be consequential. Because large themes rarely unwind quietly. They recalibrate entire systems. The question is not whether artificial intelligence is transformative. It almost certainly is. The question is whether markets have priced the transformation correctly. Every major innovation cycle carries two parallel stories. One is technological progress. The other is financial expectation. When those two stories stay aligned, growth is sustainable. When expectation runs ahead of execution, volatility follows. AI is no longer a niche theme. It is embedded in index funds, retirement accounts, corporate balance sheets, venture capital portfolios, national industrial strategy. That scale changes the risk. Small bubbles affect sectors. Large bubbles influence systems. And the AI investment cycle has grown large enough to matter beyond technology. If valuations continue rising and earnings validate them, the cycle stabilizes. If growth slows, repricing begins. If repricing accelerates under tight liquidity, volatility spreads. But the most important insight is this. Even without a crash, expectation resets can reshape markets. Slower momentum. Lower multiple expansion. Reduced capital inflows. Tighter funding conditions. None of these require panic. They only require recalibration. And recalibration in a concentrated market environment can still be consequential. The AI story is not ending. But the financial cycle around it will evolve. Understanding that evolution matters. Because capital cycles connect to labor markets. Labor markets connect to consumption. Consumption connects to growth. Growth connects to debt sustainability. And debt sustainability connects back to financial stability. These systems are not separate. They are layered. In the next episode, we shift from AI back to visible cracks in the real economy. Because financial cycles eventually surface in tangible ways. Next, the car repossession crisis. If you want to understand how innovation, leverage, debt, and capital flows interact beneath the headlines, subscribe. Not for fear. For structural clarity.